Welcome to our channel, traders and investors. Did you know that covered calls are a popular options trading strategy used by many investors to generate extra income? It's a great way to earn some extra cash from your existing stock portfolio. And today we're going to dive deeper into how you can make the most out of it. When it comes to making more money through selling covered calls, the potential benefits are huge. Not only can it provide a steady stream of income, but it can also help you manage risk and boost your overall portfolio performance. But before we get into the nitty-gritty, let's take a step back and look at the bigger picture. A covered call is a financial transaction in which the seller of the call option owns the underlying stock. When you sell a call option, you're giving the buyer the right, but not the obligation, to buy the underlying stock from you at a specified price on or before a certain date. In return, you receive a premium from the buyer, which is essentially free money. But here's the catch. If the stock price rises above the strike price, you'll be obligated to sell the stock at the lower strike price, missing out on the potential upside. So why would anyone sell covered calls? Well, for starters, it can provide a steady stream of income, and it can also help you manage risk by limiting your potential losses. Of course, there are risks involved, and it's essential to understand them before getting started. If the stock price plummets, you could end up selling your shares at a lower price than you wanted to. And if you're not careful, you might get caught out by a sudden surge in volatility. But with the right approach and a solid understanding of the strategy, you can mitigate these risks and reap the rewards. When it comes to selecting stocks for covered calls, there are a few key factors to consider. First and foremost, you need to choose stocks that are stable and relatively calm. You don't want to be selling calls on a stock that's about to skyrocket or plummet in value. You also need to consider the dividend yield, the implied volatility, and the overall market conditions. By carefully selecting your stocks and setting the right strike price, you can maximize your returns while managing your risks effectively. But it's not just about selecting the right stocks. It's also about having the right mindset. You need to be comfortable with taking on some level of risk, and you need to be willing to adapt to changing market conditions. By staying flexible and keeping a close eye on your portfolio, you can make the most out of selling covered calls. Let's cover some basics. You need to understand the four basic parts of what comprises a stock option. First is the call option. This is a contract that gives the buyer the right, but not the obligation, to buy a stock at a specific price, known as the strike price, before a certain date, called the expiration date. Second is the strike price. This is the price at which the stock can be bought. Third is the expiration date. This is the date by which the option must be exercised. And fourth is the premium. This is the income you receive from selling the call option. Understanding these terms is crucial for effectively selling covered calls. Now let's get into the step-by-step process of selling covered calls to increase your returns. Step 1. You need to own at least 100 shares of the stock you want to sell calls on. This is because each options contract represents 100 shares. Choose a stable, well-performing stock in your portfolio. Step 2. Select the strike price and expiration date for the call options you want to sell. Strike price should be above the current stock price, ensuring you're willing to sell your shares if the price rises to that level. The expiration date can be weekly, monthly, or further out, depending on your strategy. Step 3. Sell the call option through your brokerage account. You'll receive a premium, which is the income from selling the call. This premium adds to your returns, regardless of whether the option is exercised. Step 4. Manage and monitor your position. If the stock price remains below the strike price, the option will expire worthless and you keep the premium. If the stock price exceeds the strike price, you may need to sell your shares at the strike price, but you'll still profit from the stock appreciation plus the premium. Selling covered calls has several benefits. First, income generation. The premiums provide additional income to your portfolio. Second, downside protection. The premium offsets some of the losses if the stock price drops. Third, stock appreciation. You still benefit from stock price increases up to the strike price. However, there are risks. The risks are limited upside. Your profit is capped at the strike price plus the premium. The obligation to sell. You may be obligated to sell your shares if the stock price exceeds the strike price. The last risk is that it requires ownership. You need to own 100 shares of the stock to sell a covered call. Let's look at an example. Suppose you own 100 shares of XYZ stock trading at $50 per share. You sell a call option with a $55 strike price expiring in 1 month for a $2 premium per share. You earn $200 from the premium. If the stock stays below $55, you keep your shares and the premium. If it goes above $55, you sell your shares at $55, plus you still keep the $200 premium. Selling covered calls can be a great way to boost your investment returns. It combines the potential for stock appreciation with the added income from option premiums. Remember to do your research and understand the risks before diving in. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more information on stock options and strategies. This video is one in a series on the subject of stock options for beginners. Please stay tuned to this channel for future videos. And leave a comment if you have other topics you would like to see discussed. Thanks for watching.